I have a question for Moses in regards to relevance of the banking industry. When you look at the recent study by KNBS regarding GDP, and this was the first time that we got a glimpse of GDP at the county level, and you looked at where growth is coming from, and every county had agricultural content as a majority of the driver of the GDP. And then when you look at the 47 counties, you realize only about 10 counties are contributing to this economy's growth. So when you think about relevance of banks, I know agriculture sounds like banks are almost allergic to that word. What is your view in terms of the future role of banks in the agri space? And then also this issue of going into uncharted waters. How long can banks compete for the same piece of pie?
I think there's a school of thought of relevance, which is, in my view, fund sectors or segments that drive economic growth. And it's a very valid view and very, very valid school of thought, which I respect. There's the other view of at what return to your shareholders will give you capital. And by the way, capital is the license to operate. So banks find themselves in this very, very tough spot. Do I lend in agriculture with the structural problems in agriculture at a loss to drive economic growth, which is what I must do as a responsible citizen? Or do I allocate capital in a way that I still generate a return for my shareholders? It's a very tough spot to be at. And I see you want to clarify something.
Yeah, because if you think about manufacturing, the majority of the manufacturing sector is all value addition to agriculture. So if you're in manufacturing, if you're in transportation, there's agri content. So banks are in agriculture, but we're not seeing it. I don't know.
Yeah, I think banks balancing that dilemma I just talked about will pick what part of the value chain guarantees that return. Collective as a whole, see how we add value and become relevant. So bank lending to agriculture is 4%, if you look at concentration of banking. Yet agriculture supports 50% plus of the economy, directly, indirectly. Yeah, I don't think we're using data adequately, but the challenge there is the availability of that data. I'll give you an example, right? So I want to be able to make a credit decision on an entire value chain, from a distributor or an outlet to who manufactures and provides supplies to that outlet, to who is at the back end of the value chain who is doing small-scale agriculture. I need to be able to look at that ecosystem with data for my risk folk to say, I'm okay to lend money across the value chain. Tell me one point of call to get data at that level, to be able to make a decision that leaves you comfortable that you're extending credit with the right data behind it, right? So there's a lot of work for the industry and for National Bureau of Statistics and other institutions to see how we bring data together that allows banks to make ecosystem or value chain-based decisions as a whole. I'd love to do that. I would love to be able to say, I want to finance every stall in Nairobi stalls that brings imports from Turkey because I'm comfortable who they sell to, because I'm comfortable that I'll be able to fund the entire value chain. Without that data and visibility of that data, the risk folks will say, all right, let me look at the spot of the value chain where I've got data to make a credit decision. That's where we are today. I think we must evolve to a point where we've got sufficient data to make ecosystem value chain-based credit decisions, which we don't today. Frankly, banks don't do that today.
My name is Michael Meshe. I'm currently the head of information technology at Triple OK Law. Yeah, so my question is, what exactly is the purpose of regulation? Because regulation came about just when we saw the first banknotes being issued. So that was its purpose, to serve that. Why is it still struggling to serve that purpose now in terms of controlling what should effectively be a free market that is self-regulating? Sounds absurd, sounds like a fairy tale, but if you could just pull the regulator out and ask the regulator, what are you doing? They look like they're fixing the bank's problems. And the bank's problems, in my opinion, regulation comes about due to malpractice and all these things. So get rid of it's a moral issue, maybe a societal issue, not a legislative or regulatory issue. Is that gotten to a point where you sit down and you're one day thinking, the best thing for me to do is to find a way for the economy to grow without me?
You are right in the sense that regulation comes in to protect the consumer. And we have seen developments where regulation falls behind and we see the consumer being exploited. And therefore, the normal response for the regulation is to even become more forceful in terms of enforcing the regulation. And so there is always that interplay between overregulation and underregulation. There's underregulation, and apparently the market seems to exploit that apparent loophole. And then the normal reaction after that is increase the regulation, and then you go into the overdrive of overregulating the market. And so there is always that interplay, in terms of the market development. But I think at the end of the day, I don't think you can talk of either we are underregulated or overregulated.
My name is Steve Biko from Barclays Bank. I want to direct this to Moses. Moses, in the current consolidation environment, so we've seen a lot of banks targeting some acquisitions, both onshore and cross-border. I think I'm more concerned about the cross-border in terms of these particular geographies where these targets operate. They're probably growing faster than the local environment in GDP terms. The question for me would be scalability of these particular geographies. So in your thinking, are they paying a fair price for these particular targets within Africa? And secondly, is there any strategic thinking about these acquisitions out of Kenya?
I think there is some strategic thinking to it for sure, right? So definitely. I think if you think about just the continent, right? So you've got South African banks who have come to East Africa and gone to West Africa. You've got Nigerian banks here, and in South Africa, cut out North Africa out because of commonality of markets, or maybe not a natural corridor to SSA, which tells you then there's nothing strategically wrong for Kenyan incumbent indigenous banks going through trade corridors into Southern or Western. Strategically, I think for me, that makes a lot of sense. Because capital follows trade, and we know banks provide most of the capital that funds these economies, not capital markets, because of just the structure of our markets. Banks will follow trade corridors. I think it's natural for banks in Kenya to go into Southern, Western, Central Africa, up in Ethiopia. I think it's strategically important, not just for the banks themselves, but for us as a country, as we think about whether we want to anchor financial markets or in Nairobi for the region. I think it helps us in that way. So if I was in a deal team for a local bank incumbent in Kenya, I'll pursue strategically those acquisitions. I think the question is always then at what price, right? So how do you pay a price that you're comfortable with short-term and long-term? You may need to overpay to open those corridors to go Pan-African. And whether you truly believe in those economies providing you the upside down the road. These are all deals are based on assumptions. I don't think there's none that has got a data point that someone can hang themselves to and say this is the right data point, right? So making those high-level assumptions, I think they're making the right strategic decisions to do that. On the valuations is where I'm a bit uncomfortable, looking at the numbers and trying to justify the price at which we are seeing some of the deals, or one deal, which has been of that nature. And again, I keep saying you never know what else is in the deal agreements. So maybe the price we see being announced is actually a discount to the actual value of those assets. So I'll just like to caution for banks to be extremely clear on what is the strategic intent. 1 + 1 never equals 2 in M&A. It's 1.75 or 1.5. So it's never above 2. It's never 2, right? So unless you're very clear on the strategic intent, then it may become difficult to justify the price.
My name is Eddie Ndishu. I represent Wapi Capital, a Kenyan-based fintech venture capital business. My question is on the consolidation conversation, and especially with the trends of Kenyan banks, as we have seen in the recent news. So mine is to understand from the better minds of the panel on the trend that we're seeing with this consolidation. One, is it hubris or obsession of the larger banks wanting a big balance sheet overnight? Or is it the law that was put in place that is reducing the margins for these banks, and therefore the lack of creativity or innovation in deploying capital, making them want to fall back into buying other banks? Because I don't believe you need to, the license is not an asset to go into any market. Why would you buy an asset in Mozambique or Zambia, or if not for the balance sheet, but definitely not for the license to be able to operate? With what we've seen with fintech companies being able to deploy financial services, business models that don't require licensing. What is the value there, and what do you see? Because I worry for these Kenyan businesses, this trend in buying big balance sheets, buying other existing licenses in different markets, while I believe they should be buying these creative fintech companies or investing in these creative fintech companies. What are your thoughts in this? And I'd like to understand what the trend is from the better minds.
It just tells you where I sit personally in terms of what's scalable, what is easy to integrate, and what is convenient for the consumer. So if I had capital and the appetite, I'll probably come have a conversation to buy a fintech. But suffice to say, M&A motives are very varied, right? There've been M&A deals where we've worked on night after night for weeks to come up with a price. And then in a boardroom conversation, the chairman says, I'm going to pay that price plus 50%. Yes. Right? Why? Just because I cannot be smaller in this market. So there are those, right? There are those, and there are many, and I've seen a couple of scenarios around those. There's the other real motive of, if I don't get bought, then I cease to exist. So there's the whole capital requirement that Habil talked about. That means that you either become technically insolvent and lose your license, or agree to be bought and continue to operate with a stake in a bigger bank that has got a bigger balance sheet or bigger capital base. So there's that motive too. There's the motive of, we want to buy something we don't have. So I'll make a choice to either go build what I don't have in whatever market or whatever country, or buy it because I don't have it. So that's another motive. I just want to believe that all the deals we're seeing have got some form of all these motives. But back to where I started, if I was an incumbent bank today and I had capital and I had strategic appetite, I'll probably be looking for bolt-on technology type companies as opposed to brick and mortar. That's my view. And then lower the chain, go for brick and mortar.
My name is Kefa Mutuma. I'm also a developer. I'd like to ask Moses Stone, you mentioned the value chain, extending credit to the value chain by combining data. In what ways do you think you could leverage technology to do that? And in one sector specifically on mortgages, I'd like to know, like with this whole hype about affordable housing and having homes for people, what's the main hindrance for the banks currently, because mortgages are not like currently growing to serve that particular market?
I think gone are the days where banks and financial institutions relied on what you'd call structured data. So how much do you earn? How much are your cash flows? Show me your audited accounts. That's still very important, don't get me wrong, to make credit decisions. But we are living in times when unstructured data has to be leveraged to make decisions, right? And back to the other question that Nuru had asked earlier, if I have to wait for structured data to make a decision on agriculture as an ecosystem, I'll wait. The relevance question will not be answered shortly or soon. So what banks are beginning to do ourselves, what we're doing with Timiza, which is our mobile banking, virtual banking proposition, is completely riding it on unstructured data. So where you say, I don't need to see your payslip or your monthly income, I want to understand your behavior and your pattern. And I want to understand it from unstructured data. And I want to be able to make a decision whether you're a small business or an entrepreneur, standalone entrepreneur, or an established business. I want to be able to make a decision to extend credit to you or to know what interest rate to give you on your savings based on all this data that I can't structure, I can't combine. So I think my encouragement for banks is to deploy technology, to your point, around using big data, or in other words, unstructured data, to make decisions, because waiting for structured data takes us back to the old age. So perhaps maybe, Habil, on the affordable housing, you may be closer to it than I am.
No, affordable housing is one of the big four agenda, and I think there's quite a bit of effort that is being put in to ensure that the affordable housing agenda is realized. And back to your question in the sense that what is the challenge that you are having and why don't we have enough units out there? And I think it goes down to how do we drive the affordable housing agenda? In other words, how do we make the units affordable? And one of the biggest drivers of the cost of the unit is actually land. Now, if we can resolve the problem of the cost of land, I think we would be virtually halfway there. And one of the alternatives is, for instance, having public land available that can be allocated to this affordable housing unit initiative. And this can be, viewed as a public good relief. If the government can provide the land for purposes of doing the affordable housing units, I think that's one way. The other one is the cost of construction. And there's now technologies are coming up in terms of trying to drive the cost of construction down for the units. Of course, I'm trying to avoid bringing in the cost of money, because that is one of the factors, but is not the only factor that drives the cost of the units. So the cost of money could come in, and of course, we know a number of initiatives that could be brought in to bring the cost of money down. Part of it is, for instance, the Kenya Mortgage Refinance Company that has been set up as a regulated entity by the central bank. A number of structures have come in. I think you must have seen in the papers an announcement of the fact that the World Bank has allocated some amount of money for this unit for purpose of capitalizing it, to be able to play its due role. And what it will be doing is that it will be issuing instruments into the market and effectively refinancing the units, and therefore being able to provide affordable capital in the market for purposes of extending that capital to the lending institutions who are the primary generators. And then, of course, at the end of the day, this has got to be at scale, so that the cost of implementing the whole program can come down. And if it can be achieved to scale it up, then effectively the per unit cost will eventually come down. And I think the whole thing has got to be viewed in that perspective, in the sense that the program has got to be scaled up so that the per unit cost can be effectively brought down.